come back to another thing that Chairman Warsh has emphasized, like Chairman Greenspan, is the rejection of the idea of forward guidance, right? Now, one of the things that forward guidance does is it makes you too late to change your mind. And so, for example, if you look at what was happening after the pandemic, the Fed was still buying mortgages at the beginning of 2022, in part because they'd guided the market towards a very slow, long path of ending these things. They didn't want to disrupt market expectations that they themselves had set. And so you get to a point at which home prices are up 20% year over year, and the Fed is still buying mortgages. They're still injecting more credit into the housing market, even though home prices are up 20% year over year. In my mind, part of that is not wanting to have disrupted the previous forward guidance that they issued. Because if you violate the forward guidance you've given, it makes your forward guidance less credible the next turn around.
Right.
And so I think one thing that we've seen from Chairman Warsh is just, I don't want to give forward guidance because I don't want to be cornered into a situation like that that made, in my mind, contributed to them being too late to turn around.
I want to ask you quick about inflation, or how to interpret or read inflation.
Now, let me make a point, which is that the Federal Reserve targets headline inflation, right? Congress gave them an overall mandate for stable prices, not for core or not for trimmed mean or median or anything else, right? It's headline inflation is the mandate. But the critical thing is that monetary policy has lags, right? Monetary policy, if you change interest rates today, doesn't affect the economy today, doesn't affect the economy next week. It takes a year to a year and a half for that to filter in through the economy. So you need to be making policy today, not for the last 3 or 6 months of inflation data. You need to be making policy today for what's going to be happening a year from now, for the second half of 2027. Right? And so people look at core inflation, and they look at trimmed mean, and they look at other measures. I like market-based core also, because I think the non-market elements have a lot of basically statistical noise in them. People look at these various ways of slicing inflation as indicative of where overall inflation is going to be a year from now. Because energy prices can be very volatile. They can shoot up and they can come down. And so if you're targeting overall prices, but you're targeting them a year from now because the monetary policy lags, looking at core, looking at trimmed mean can be more helpful in predicting where things are going to be a year from now than looking at headline. And so then it comes down to a question of which is going to be more predictive, which is going to be a better forecast of where things are a year from now. And that's going to depend a lot on what's driving the different measures.